Hello students, welcome to my class. This is Professor Vincent Usaya, and this is part 4 of chapter 11 presentation. Chapter 11, current liabilities and payroll. So the last section of chapter 11 deals with contingent liabilities. Like we discussed earlier, contingent liabilities are those liabilities that are contingent upon something happening or not happening in the future. In other words, it is liabilities that we are likely to be obligated for in the future depending on what wind up happening or not happening. So let's take a look at the example that we have here. This company was sued for infringement of patent on its videos. Now, take a look at the main issue here. The main issue here is, how do we record the liability? Or should we record it, or should we disclose it? Remember, we talked about disclosure, meaning notes to the financial statements. After preparing the financial statements, we also have additional explanation that we have to make, explaining how we come up with some of the numbers on the financial statements. We call those disclosure or notes to the financial statements. So here are two issues here in terms of whether to record or not to record contingent liabilities in our books. Number one, how likely is the future event? Number two, can the amount of the liability be reasonably estimated? So let's take a look at a diagram here that helps us to determine how to record or not to record the contingent liability. Take a look at what we have here. Number one, can the liability be estimated? That is the amount. Look at the probability of future sacrifice. Is it probable that we are going to lose the case? What is probable? Meaning it is very, very likely, based on the evidence available to us, it is very likely that we are going to be stuck in the future for X amount of dollars. That is what we mean by probable. If it is probable and the amount can be estimated, look at, we record the contingent liability. We actually record it in our journal ledger. Now, if the amount can be estimated, but it is reasonably possible that we lose. In other words, it is not probable, so reasonably possible, then what we do? We don't record it in our journal ledger and report it in the financial statement. Rather, we disclose it in the notes to the financial statement. We just write it and explain it. All right? Now, if it is very remote, it is not likely at all that we are going to get stuck in the future. We don't do anything. We don't record it. We don't disclose it. All right? Take a look at the second one. Second level cannot be estimated. Then in such second, it's probable, you don't disclose it. If it is reasonably possible, you disclose the liability. If it is remote, then you don't do anything. Okay, contingent liability is really not too much of a big issue. It's not very important in this class. When you get to upper level accounting classes, we have that to worry about. So here are other kinds of contingent liabilities. Environmental cleanup costs, so on and so forth. Like I said, this is not drastically important. You can go through this on your own and enjoy the reading. Okay, so that is pretty much the end of chapter 5. So one more issue. Times interest and ratio to evaluate business. This is the ratio that we simply use to determine a company's ability to pay interest. And here's the formula. The formula is you add the income tax expense and interest expense to net income and divide by interest expense. Now, so take a look at the demonstration of that ratio. Here we have 6.22. The higher this ratio, the better off the more likely that the company will be able to meet its obligations. So that is the conclusion of chapter 11 presentation.